Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Jeff Deist, president of the Mises Institute. Jeff, welcome to Wall Street Silver.
Good morning, gentlemen. Great to be with you.
Yeah, it's an absolute pleasure. There was a Fed official who gave an interview about a few weeks ago, Jeff, and he said he looks at the prices of frozen lasagna to gauge inflation. How insane is that in your view?
Yeah. We get these everyman takes. Like these guys and gals are going to the grocery store, just like average people. And I don't know if you saw this the other day, but Jerome Powell was being asked about his salary as chairman of the Fed, which is 190 something thousand dollars, which struck me as shockingly low. But he was basically saying that whenever he sells something, he's worth about 25 to 50 million dollars. Whenever he sells something, he has to disclose it. And so he was basically insinuating that he can't live on $191,000 a year, which is probably true if he lives in Washington, D.C. And whenever I hear this sort of everyman thing, it exemplifies their cluelessness. I mean, this is what average people do with. If you make less than, let's say, $40,000 US in your household in the West, food and gas are your number one daily headline, right? People who make less money spend a higher percentage of their income on basic necessities. And so, it's nice when Fed officials try to have that common man, aw shucks touch, but it's just this whole thing is very unbelievable. And I'm frankly not interested in hearing the arsonists talk about putting out the fire. I mean, can all be laid at their feet. It was an express program of inflation. And now that it's here and it's a little out of control, they want to walk it back, and it's not going to work.
So that's an interesting point you make. So let's move on a little bit to the Federal Reserve and what they're doing. The Fed Watch tool, Jeff, is on interest rates, is predicting another 25 basis points, right? And there's a 90% chance in March that they're going to do that. And then after that, they're shifting to 2 more rate increases and then maybe some decreases later in the year. Are we in the final stages? What's your view?
I suspect Jerome Powell wants this. To what extent he actually runs and is the ultimate decision maker in the FOMC, for example, is an open question. I mean, some Fed leaders, it's their way or the highway. He seems more like a consensus guy. Danielle DiMartino Booth, who's a name I'm sure many of your listeners know, she knows Jerome Powell a bit, worked with him. So I look to her judgment on his mindset. I do think he wants more rate increases. I think he doesn't understand the real unemployment numbers, in the sense that a lot of people simply aren't looking because they never came back. They're just stayed home since COVID. And so I think he's using the idea that unemployment is still low and the job market is still frothy as support for his, a couple more increases in the Fed funds rate, or targeted increases, I should say. We always have to be careful. They can't raise and lower rates. They can target rates. But I think at the end of the day, there's a couple constituencies here. The Fed member banks, the commercial banks themselves, that's the real constituency of the Fed. They have stock prices, they have bonuses. I think Jerome Powell has to err on the side of serving that constituency over that under $40,000 a year family who's worried about the cost of their lasagna. So I think these rate hikes are, limited, maybe a couple more, yes, maybe, half a basis point. But I just think if the Fed is going to come down on the side of equity and bond markets or the side of common people, I think it's going to be equity and bond markets. And both of those are hurt by higher interest rates.
Now, we were speaking a little bit before we started recording, and we were talking about what's the role for gold and silver in the economic system as it stands. Do you want to touch on that?
Yeah, it's such an interesting question because on the one hand, there's no official role. Gold and silver are not exchanged as actual media of exchange in the West, or really even in the East. And as such, governments have done a pretty good job. Central banks have done a pretty good job of pushing gold and silver out of the way and allowing politicians to have their true fiat currencies, which is what they want. They don't want any limits on their expenditures, and they don't want interest rates to be a market phenomenon. So certainly Western governments and central bankers have basically achieved that. So why do central banks, not necessarily the Western ones, but why do central banks continue to buy gold? We're reading reports of more and more gold being purchased. It's hard to get accurate data on that. And then why do they hold it when it's not a monetary asset? Ron Paul asked Ben Bernanke this. He said, well, it's just because of historical reasons. In other words, why don't they hold diamonds? Why don't they hold barrels of oil on their balance sheet, or bushels of wheat, or wheat futures? Wouldn't have to be the actual commodity, of course. And the reason is that gold and silver have a stubborn degree of moneyness to them. And so I agree with, for instance, Keith Weiner of Monetary Metals, who says, well, the reason they're buying it is because they're looking to shore up their balance sheet with an asset that's not dropping. Look at the Fed's balance sheet. Look at all that QE Treasury debt they bought up beginning way back in 2008, and really almost continuously since then. There's been some lapses, some tapering, but they started it up again in 2020. Almost all of that debt is at much lower interest rates than, let's say, current 10-year Treasury yields. So they're having huge losses on their bond portfolio. And so if I were a central banker, especially if I was one which led a bank which had some geopolitical interests, let's say, averse to the United States, like China or Iran or India, perhaps, or Russia, I might want an asset that's at least going to hold its value, like physical gold did throughout 2023, if not go up. So there's a little bit of tug of war here. Gold and silver, they never go away. They always have a degree of moneyness. I think we could revert to them pretty quickly in some sort of true crisis. I don't think the dollar is in trouble against other currencies, but if it ever were, that's a real option. And so, why do gold and silver just hold their value over millennia? I think we have to at some point say they're perfect tech. They're like the wheel, or they're like fire. Right? Bitcoiners think they came along and created better tech, and you can argue that point. But gold and silver, the immutability of them, it really astonishes me, and they just can't get away with eliminating their moneyness.
Right. Now, you well said, Jeff. With all the chaos in the market, Jeff, where are you putting your money right now? Is it gold and silver or other commodities?
Well, that's where my teenagers are putting their money, because I really want them to have a sense of skin in the game and risk. And I want them to have part-time jobs and understand how you hopefully, it's one thing to make some money. It's another thing to hold on to it.
Right.
And so, I still think there are, I think the next 10 years, let's say, if I had to predict, and I'll put my money where my mouth is in my personal life, I think the next 10 years are fairly inflationary. I don't think they're going to be able to get back to those levels that we enjoyed, well, at least ostensibly enjoyed in CPI over the last 20 years or so. And I think several things are bullish for physical precious metals. I think several things are bullish for commodities. And I think several things are bullish for emerging markets, because the part of what's happening with oil, part of what's happening with the dollar, part of what's happening with this Russia-China realignment thing is that the West has been profligate. Its governments have spent more than they brought in taxes for decades. And the rest of the world is starting to wake up and say, hey, I don't want to invest in their fiscal house any longer. Why should I? Why should we be under their thumb for settling international payments, for purchasing oil, whatever it might be? We have our own interests, and this Uncle Sam guy is a drunk and a spendthrift. So, there's always this sort of slow Cold War happening with currencies, and people like Jim Rickards have written about it and know a lot more about it than I do. But I do think that I will rigorously limit my own personal decisions to things that I understand. I will never kid myself about what I don't know.
Right.
And so I will stick to things that I understand, like precious metals and maybe some derivatives therefrom, and commodities. And that's about it. And I also think that holding US dollars, in other words, a cash balance, is not the worst thing right now. I understand that inflation is a painful tax to pay, but I do think that the US dollar is going to continue to do well against other currencies for the foreseeable future.
So, Jeff, do you think the Chinese yuan will end the US dollar's dominance, or is it all hype? A lot of people have been talking about this lately.
Oh, wow. That's almost a military question or a strategic question as much as it is a monetary question. I think that's hype, in my opinion. My current thinking on this is from the newish book, came out last year, called The Price of Time by Edward Chancellor, British financial journalist. Brilliant guy. I really love him, really love the book. And he did a pretty deep dive into the Chinese economy, the savings rate, which we hear touted a lot about, Chinese people save more money. And it turns out that a lot of this Chinese economic miracle is not as advertised, at least if you read the one particular section in Edward Chancellor's book. So I'm going to say that's a bit of hype. I would also say that all of, so much of China's growth has been premised on exports to the West. Right. All that stuff we love to buy in Walmart. Now, increasingly, some of that's moving to places like Turkey, Vietnam, Mexico, Sri Lanka. The Chinese manufacturing dominance is waning, is being challenged. But I think, the Chinese government is realistic. They're probably more clear-eyed than ours, and they have a symbiotic relationship with Western consumers. And I think they are just going to have to grit their teeth and bear it for the time being. And I think their own monetary policy, their own fiscal policy, their own demographic issues are at least as bad as ours. So no, I don't think the yuan is going to supplant the dollar anytime soon anyway.
Super interesting. Well, Jeff, we want to thank you for coming down to Wall Street Silver, and hopefully in the next 2-3 months, we can have you back on.
Well, I want to thank you for your work and for your awesome Twitter, which really helps me learn.
Yeah, no problem. We genuinely thank you. So thank you again, and hopefully get you back on in 2-3 months. Take care.
Okay. Thanks, gentlemen.